Welcome back. You're still tuned into Market Fatafat right here on ET Now, and this is a show where we discuss all the stocks that are buzzing in trade today. And on the technical side, we are now joined by Sneha Seth, derivative analyst at Angel One, and on the research side, we already have Kanishka with us. Sneha, Dr. Reddy's, that's the first stock that you've picked for us. Tell us, where do you see the stock headed and why have you picked up this stock?
So if we look at the chart structure for this counter, we have seen this counter correcting towards its 89 EMA, which also coincides somehow around 200 is simple moving average. And from there onwards, we are seeing some buying interest coming in today's session. Apart from that, we have also seen some consolidation in last couple of sessions during that support zone. So looking at the overall chart structure, I believe this counter looks poised for an up move, at least towards 1350, 1320. That is the level which I'm watching for this counter. Someone who wants to go ahead and take a long position can think of going ahead with this counter, because if you see Nifty is somehow being little tentative at the higher levels, and farmer space from this pack, I believe Dr. Reddy can do quite good.
All right, so that's Dr. Reddy's on the charts. But moving on to the next counter that is in focus, Kanishka, Maruti, tell us why is this stock in focus?
That's right. So this stock is in focus because of two reasons. First up, an ET report says that the production at India's largest car maker, that has dropped to a 5-year low in June. This was hit by sluggish demand in its small cars and compact sedan segments. Now, apart from that, the company is also pushing ahead on safety. From July 16th, that is yesterday, 6 airbags have been made mandatory, have been made standard in Ertiga and Baleno models of Maruti. This, in fact, has led to a price hike of 1.4% and 0.5% respectively for both these models, as Maruti is targeting full airbag coverage across its fleet by year end. Hence, the stock is in focus, currently trading about 0.5% lower.
That's Maruti Suzuki for you, down 0.5% as we speak. But let's also put the spotlight on big boy Reliance Industries. That one is all set to report its numbers tomorrow post-market hours, and on a consolidated revenue or basis, net revenue is expected to decline by about 6% on a quarter-to-quarter basis to come in at 2,45,700 odd crores. As far as margins are concerned, we are working with a figure of 18.3% versus 16.8% that the company had reported in the previous quarter. Let's also look at the segment-wise performance then. Retail EBITDA, that one is expected to fall 2% QOQ. Digital services EBITDA, meanwhile, could rise by about 4% on a sequential basis. This is on account of pass-through of tariff hike in the telecom sector that the company had undertaken in the previous quarter. O2C EBITDA, that one too is expected to rise higher by about 5%. This is on account of higher margins, partly offset by refinery shutdown in the quarter gone by. Management commentary on the 75,000 crore investment that they have announced for new energy business, growth in retail and pricing action in telecom will be keen this time around. But yes, all eyes will be on Reliance Industries ahead of its numbers tomorrow.
All right, all eyes on big boy Reliance ahead of its quarter-1 numbers. But let's move on to the oil and gas space, where India will continue to buy cost-effective oil from whatever it is, whenever it is available. That's the word coming in from the Petroleum Minister Hardeep Singh Puri. Now, despite the sanctions in certain countries, he remains rather confident of no disruption as India explores boosting imports from countries like Brazil, Guyana and Canada. Let's take a look.
If Russia carries out an operation somewhere else, I'm surely, when I started buying, it was not either because of that or as a consequence of, it's when energy becomes available. We are buying from Argentina. I think we bought 2 consignments. We are wanting to buy more from Brazil. I think this situation today fundamentally is characterized, madam, by enough supply. I would say there's more supply. I see the price coming down. If some sources for some reason dry up, yes, there will be some uncertainty. But the end of the day, the question is going to be, do we have the navigational resilience, I'm coining a new word, to steer the ship through? I think I'm very confident that we do have it. Past discussion on buying Russian oil was never subject to a sanction. It was subject to what is called a price cap. And in front of this very distinguished large audience, I have no hesitation in admitting that I'm happy to buy under a price cap. And then the price cap makes me get the oil cheaper. But by the way, I have a simple system. My OMC sitting here, they float tenders for import at our, and whoever can supply the particular grade of crude at that point of time, who is the cheapest, they will award the tender to.
All right, that is Hardeep Singh Puri talking about oil imports. But let's move on to the next counter that is in focus, and that is L&T, where Citi is maintaining a sell and they have reduced the target price to 4,015 rupees from an earlier 4,055 rupees. Now, the company has reported a weak set of Q1 numbers with revenues coming in low while the margins were in line with the expectations. Now, management has reiterated double-digit FY26 revenue growth supported by a strong backlog order book and a healthy pipeline of deals. Management also indicated that the second half of the fiscal year is likely to be better than the first half based on multiple client conversations and another quarter of large deal wins. Morgan Stanley also came out with a note where they're maintaining an equal weight and they've hiked the target price to 4,500. Now, the company's results they feel were in line with their expectations. It has performed well on deal wins over the past 3 quarters and they're rather optimistic about the revenue conversion going forward. The margin recovery, however, is expected to be rather gradual. They also foresee no major negative surprises with a near-term positive bias, and despite this, the upside potential for the stock is limited. So on the back of these brokerage calls, L&T is in focus today, though has managed to recover from the day's lowest point, is nonetheless reeling under pressure with cuts of 0.3%.
Okay, so that's the fundamental reason as to why the stock is in focus. But Sneha, at 3490, where do you see L&T headed from here on?
If you look at the chart structure, this counter has been consolidating, wherein I believe 3,480, 3,470 zone has been acting as a support. But looking at the overall chart structure, I believe there are chances that if the counter corrects below 3,470, 75, there are chances that this counter can correct at least towards 3,300, 320. That is the level which I'm watching for. For now, if someone wants to go ahead and short this counter, can go ahead, keeping a strict stop loss of around say 3,550 should be the stop loss, and downside potential will be around 3,320.
All right, so that's L&T on the charts as well. But let's move on to Kanishka. You picked out Zidus Life for us. Tell us why is Zidus in focus today?
Right, so Zidus Life Sciences is in focus because the US FDA that has conducted a remote regulatory assessment, that is RRA, at Zidus Formulations manufacturing facility in Matoda in Gujarat for the prior approval supplement of a calcium tablet. Now, at closure, no observations were noted and the site was recommended for approval. Now, following this FDA assessment and approval for the Gujarat facility, the stock continues to be in focus, trading more than 1% higher.
Zidus Life Sciences up 1.4% as we speak. Let's also put the spotlight on SBI then on the back of their fundraising plans, where the bank has launched a 25,000 crore QIP. Now this has been done at a floor price of 811 rupees per share with an offer to with an option to offer up to 5% discount. The floor price is at a 2.3% discount as compared to the current market price, and the bank is looking to raise about 25,000 crores via this QIP. Now, as a result of this QIP, Tier 1 ratio is likely to increase to 12.95% from the current 12.1% mark. Net worth is likely to increase from 4.41 lakh crore to nearly 4.66 lakh crores. This implies an increase of about 6% as a result of this QIP. Book value could rise by more than 2%, and at the floor price, this could also result in an equity dilution of about 3.5%. So on the back of this 25,000 crore QIP that the bank has launched, the stock continues to be in focus, although it has given up all of those morning gains and it is trading absolutely flat as we speak.
All right, moving on from SBI on the back of that QIP, we are moving on to the next counter, which is Indian Hotels, which is likely to come out with its Q1 numbers. Now let's take a look at what can we expect. On the revenue front, we can see an uptick of 27.5% on a year-on-year basis, or a revenue of 1,976 crores is what we're expecting. On the PAT front, we see an uptick of 31% on a year-on-year basis at 325 crore rupees. On the EBITDA front, we see an uptick of 28.3%, and the margins can be at around 29.5% versus 29%. So a slight uptick coming in on the margin front as well. Now, what are the key expectations? We expect the earnings growth that is partly aided by the Taj's SATS consolidation. And remember, Taj SATS is now subsidiary versus a joint a JV earlier. This was announced last quarter, due to which ISCL saw a one-off gain of 307 odd crores. Now, Taj SATS is likely to grow at a high teen year-on-year, is likely to see a high teen year-on-year growth. Ginger portfolio is likely to grow by 20-odd%. High single-digit growth is what we are expecting from the international segment, and the ARR is likely to grow on a 7% on a year-on-year basis, and the RevPAR growth is likely to be anywhere between 12 to 14% on a year-on-year basis. So, on the back of the results that we are expecting, Indian Hotels is in focus.
So all eyes will be on results later today. But Sneha, how are you positioning yourself in IHCL ahead of its numbers?
If you look at the counter, it has been taking the support from the support. Like if you see the weekly chart, there is a rising trend line support, which counter has been respecting since last couple of times whenever it has taken a dip. And looking at the overall chart structure, I believe the counter looks positive for an up move. Especially, I believe the counter can head towards 780, 790 is the level which I'm watching for. Once we see a move above this, or this is an immediate resistance zone, but any move above this can bring this counter at least towards 850, 860 zone even. So at this point in time, it's been from mid of May series, we are seeing this counter trading in a range, where on the lower side, the support is around 720, on the higher side, the resistance is around 780. So this is the range. Once we see an up move above the resistance zone, which is very much likely, looking at the overall chart structure, we may see a sharp move towards 850, 860 zone.
All right, so that's what we are penciling in for Indian Hotels on the charts as well. Let's move on to the next counter, which is Ramco Cement. Kanishka, tell us what's the news flow for Ramco?
Ramco Cement has commissioned a major railway siding project, the new logistics infrastructure. This spans approximately 23 kilometers of track and includes a wagon tripler system. Now, this is to boost efficiency in material handling as well. Now, the move that is expected to improve significantly the company's supply chain and reduce transportation costs, which would enhance its overall operational strength. And so, on the back of this, the stock is in focus, however, still trading about 0.5% lower.
That's as far as Ramco Cement is concerned. That one is down 0.5% as we speak. But let's put the spotlight on the real estate sector then. And DLF is in focus as the company will launch its first project in Mumbai's Andheri suburb on the 17th of July, that is today. The first phase of the West Park project will include over 400 apartments. So that's a development that is coming in, and DLF now entering the Mumbai market. And the stock is in focus on the back of that, up 0.2% as we speak.
All right, speaking of DLF then, DLF is making its debut in Mumbai with the launch of the West Park in the suburbs, like Ashisha mentioned, suburbs of Andheri, with more than 400 premium apartments in its first phase, and prices are ranging from 5.5 crores to 7.5 crores. My colleague Anurag Joshi caught up with the joint MD and Chief Business Officer. Anurag Shah caught up with the MD and the Chief Business Officer to talk about their pricing and strategy to thrive in an extremely competitive market. Let's go across and take a look at this conversation.
It's a very competitive price right now. I think we are in the first stage. We are extremely overwhelmed with the support that we have had for the project, and our average price, because there are three categories of apartments: 1,100, 1,300, 1,500 approximately, and price ranges from 40,000 to 47,000, average about 40 to 43. So it's a very competitive price. But most importantly, I think price is secondary. I think what is important is what DLF is bringing on the table. It's a lifestyle product with amazing amount of amenities, and DLF is known for its lifestyle, right? It's not about just a brick and mortar story. There's a lot of work is being done in maintaining and running such facilities. I think that's what we've known for over the last 70, 80 years, and that's what we will bring to Mumbai.
Going ahead, we'll see more projects in Mumbai, and how margins are different in Mumbai as compared to other parts of the country.
No, definitely. As I said to you, I will answer that question. We'll cross the bridge when we come to it for more projects. But first, as I said, we want to tee this off nicely. We want to concentrate and make sure that there is a certain amount of mark that we make here. We're in no hurry. And of course, margins, whether it is Mumbai or Gurgaon, the predominant factor for DLF will remain margins. So margins is something that all our projects across the country will have to make.
So DLF has now entered the Mumbai real estate market, but on the technicals, Sneha, from 846, where do you see the stock headed?
If you look at the chart structure, this counter had made a very strong support zone around 625, 630 or so. And from there onward, we saw a move at least towards 880, 890 was the level which we saw recently. After that, in last couple of weeks, we have seen some consolidation or some profit taking from the higher levels. But if you look at the chart structure, the counter has made a strong support on an immediate basis around 810, 820 levels. So I believe someone who wants to go ahead and long, this is the right time for this counter. It has been recovering. It has been forming a higher top, higher bottom kind of structure now. And very much possible that the counter can head towards 880, 890 zone, and we can see an up move after this. A very strong up move can be possible once we see a move above this. I believe then we can see a move extending towards 940, 930 easy level, which I'm looking forward. So I think the risk reward ratio is quite good. The counter has been taking a support. The chart structure is good if you talk about daily or a weekly chart structure. So I believe one can go ahead and take a long position over here at current price even.
Okay, so you can take a long position in DLF, that's the word coming in, but let's keep it going with the real estate sector then. And Godrej Properties, that one is also in focus because the company informed the exchanges that the company has acquired 50 acres of land for a plotted development with an estimated saleable area of about 9.5 lakh square feet. In fact, Gaurav Pandey, MD and CEO of the company, also said that they are delighted to announce their entry into the dynamic city of Raipur. This acquisition marks another significant step in their expansion journey as they look to strengthen their presence in emerging real estate markets across India. So, Godrej Properties, that one has entered into the market of Raipur, and the stock continues to remain in focus, up 1.5% as we speak.
All right, that's Godrej Properties in focus on the back of that news flow. But Sneha, on the charts also you picked up Godrej Properties for us. Tell us what do you see here, because this one's been in a consolidative phase. It's been correcting. So from here on, do you see an up move coming in?
It's very much possible. If you look at the this week, we have seen an up move. The counter has taken a very good support zone on a weekly chart around the 200 simple moving average. From there on, we have seen some buying interest coming. Though in last couple of weeks, we have seen some consolidation at the higher levels. But again, the counter has made a good base around 2,190 odd levels. And from last 4 sessions, this counter has been showing a positive close. So I believe looking at the overall chart structure, the move can be extended towards 2,450, 2,480 is the level which I'm looking forward. So someone who wants to go ahead and take a long position, someone who's already holding can continue to hold for the target of 2,480. And once we see an up move above that, that would be very interesting, because if you see the counter will surpass these 200 simple moving average on the daily chart, which will be very interesting development. So keep a note of that, and one can continue holding this count.
Okay, so that's Godrej Property on the charts then. And Kanishka, a whole host of pharma stocks are also in focus on the back of latest IPM data. Tell us, what does the data indicate?
That's right. So the data indicates that the pharma market did show signs of revival in June. Our IPM growth for June, that came in at 11.5%. That marks the first double-digit expansion since December of 2024, and the strongest volume growth since November at 4.8%. Now, cardiac and respiratory therapies led the way. Cardiac grew nearly 15% on a year-on-year basis, while respiratory clocked 18.9% of growth on a year-on-year basis. In contrast, segments like gastro, derma, gynae and anti-infectives lagged the IPM average. Anti-diabetics, anti-infectives and GI therapies, they also grew by 10.5%, 10.9% and 9.5% respectively. And hence all these counters, including Glenmark, Alkem, Zidus and Torrent, they outperformed, whereas Dr. Reddy's, that was in line, while Cipla and Lupin trailed the market growth. And hence all these counters continue to be in focus.
All right, so that's the pharma pack that is in focus today. But coming to you then, Sneha, you picked out one from the FMCG pack. That's HUL. Tell us what you see on the charts for HUL, because this counter hasn't really done much. I mean, so from here on, do you see momentum to pick up in HUL?
The overall chart structure looks good in this counter, and though we have seen some recently, we have seen some consolidation. But yes, the overall chart structure is quite good. The counter has surpassed the resistance price around 2,400 and now trading around 2,500, 520 zone. It has been consolidating on the higher side, and I believe once it surpasses the level of 2,530 on a closing basis, we may see a sharp up move, because if you see, we have seen a decent up move along with volumes. So I believe the counter looks very good, and I believe we may see an extension of this move at least towards 2,650, 620 is the level which I'm watching for. Someone who wants to take a very short-term trade for a day or two even, they can even go ahead and enter this counter, keeping a strict stop loss of around 2,490. An upside potential target for that would be around 2,600.
Okay, so that's the view coming in on HUL. But Sneha and Kanishka, thanks so much for joining us and giving us all the list of stocks that are buzzing in trade today. But shifting focus to the primary market then, Smartworks co-working spaces listed on D Street at a 7% premium. Harsh Binani, Executive Director, and Nitish Sarsa, Managing Director, discuss the growth for the company ahead post the listing. Listen in to a slice of this exclusive conversation.
In a short span of 8 years, which included 2 turbulent years of COVID, Smartworks has emerged as the largest player in the segment, managing over 10 million square foot. We are very thankful. We have a lot of gratitude for the overwhelming support and subscription that we saw in our IPO, which not only saw a close to 14x subscription, but interestingly had more than 450,000 applications, indicating the growing confidence that a lot of retail and HNI investors have in this business.
Right. Next, I want to understand a part of this issue is going to go towards the debt repayment, but a part of it is also for fresh capital to be infused in the company. So, what do the growth plans for the company look like in the next, let's say, 3-5 years?
Smartworks has grown significantly in the last 2 years. If you look at our footprint, we've grown from 6 million to 10 million that Harsh already mentioned. Just in the first 3 months of this year, we've increased our footprint from 10 million to 11.5 million square foot already. I think the opportunity in India is massive. We're not even 2% of India's commercial RE at this point of time. And looking at how this industry is growing from 80 million currently, projected to grow up to about 145 to 147 million square foot, Smartworks has been able to grow 1.5 times faster than the industry in the last 3 years. And we think there is a runway for us to grow at the same pace.
What does the competitive landscape really look like? There are a lot of, new companies that are coming up in this space. Managing office spaces is a hot industry, if I may say so. So, what does how do you read this competitive intensity, and where does your moat or USP lie?
Smartworks' unique ability to take up large individual buildings, convert them into campuses, and cater to mid to large enterprise clients is what sets us apart. We've been able to grow faster than anyone else in this sector because of the business model choice that we have. We are the trend setters, we are followers. We have realized that India has a massive opportunity with respect to servicing of mid to large enterprises. There was a significant gap. We fulfilled that gap with our product.
All right, that Smartworks that's made its debut today, and it listed at a premium of 7% on the bourses. But let's move on to the private equity space, where private equity firm KKR released its mid-year outlook report. They continue to hold a positive outlook on India, and they say that the country's domestic and consumer-driven economy will continue to drive growth. My colleague Anurag Joshi is joining in with the details of the report.
Private equity investor KKR and Company continues to see India as one of the most compelling strategic allocations within emerging markets. In its mid-year outlook for 2025, KKR says that India's relative insulation from the global trade friction remains intact and is supported by the country's predominantly domestic and consumer-driven economy. The services-focused export sector is less vulnerable to tariffs. And as the global trade landscape recalibrates, India is well positioned to increase its manufacturing share. Structural reforms such as PLI and easing of the FDI rules are key to the government's efforts to attract long-term capital inflows. At the macro level, RBI rate cuts and the recent fiscal year budget injects the meaningful stimulus. Structurally, India presents a unique combination, and for investors, the country offers diversification, benefits, and also the local equity markets correlation with the global indices has declined, and KKR says its core investment thesis about India remains compelling.
Thanks, Anurag, for joining us with all those details. But that's all the time we have in this edition of the show. Don't go anywhere. Closing trades will take you through the last hour of trade.